外国人正在疯狂离开中国，你身边还能看到老外吗？分享一组惊人的数据啊，长居中国的老外呢正在急剧减少。过去10年，法国人减少40%，美国人减少23%，德国、日本、意大利呢也有不同程度的减少。作为我国最国际化的城市，上海11年呢还有20万老外，21年就只剩下16.3万了。望京作为北京最大的韩国人旅居点，曾经有10几万韩国人在此旅居，现如今呢可能就剩2万了。放眼全国，外国居民占比只剩了0.05%，比例呢甚至还不如老挝、柬埔寨。
Since March 2023, the action of the Chinese government have commanded global attention. The arrest of 5 employees from the corporate due diligence company Mintz Group, questioning faced by management consulting firm Bain Company in Shanghai, and an unexpected raid on information services provider Capvision in Suzhou, have put consulting firms in China under unprecedented scrutiny. This series of high-profile events has prompted deep reflection on Wall Street, leading them to reconsider their past perceptions of China and President Xi Jinping. Gradually, they have come to realize they may have misjudged the situation. The focus of Xi Jinping on personal power control at the cost of China's economic development has posed a danger not just to China but globally. The business environment in China has rapidly deteriorating, making it difficult for Wall Street to profit in the 60 trillion financial market. At this juncture, the Chinese Communist Party and Xi's proxies have dispatched numerous emissaries to Wall Street, hoping they will continue to invest in China. However, the Wall Street Mongols, now in a state of remorse and reflection, no longer have time to listen to the Communist Party lobbying. Hardly anyone is willing to side with the Chinese Communist Party or advocate for Xi Jinping, marking a significant shift in Wall Street's political stance as they begin to move away from China. This is a notable symbol of the new era. The world is starting to understand the true nature of the Communist Party of China. One of the iconic changes is a shift in the attitude of renowned American investor Ray Dalio. Since 1984, this investment titan has been full of enthusiasm for China, but after his visit to China in the spring of 2023, he was filled with concern. He fears that a Sino-US conflict may erupt within 18 months, bringing a shock to the global economy. He sees investors' enthusiasm waning and Chinese officials' focus shifting to Xi Jinping's new thought, neglecting the importance of economy and finance. He began to criticize Xi Jinping's leadership style, describing it as autocratic and egocentric, and believes that China has entered a planned economic model that is overly top-down, giving little room for grassroots staff to exercise their initiative. Therefore, he began to gradually withdraw from the Chinese market. This represents a significant shift for a seasoned investor like him. He and his investment team began to divest from Alibaba, Didi, JD.com, and other Chinese concept stocks, turning their investment sites to places like Singapore. While Xi Jinping may have hoped for Dalio to continue to praise China highly, Dalio pointed out the actual predicament China currently faces: real estate, debt issues, the weakening impact of COVID-19 related policies on the economy, strict regulation of tech companies, Sino-US conflict, deterioration of the global economic environment, and population problems. He considered these as barometers and indicators of China's economic development. These issues have made him pessimistic about China's prospects. He predicts that China's rapid economic growth and its position as a manufacturing powerhouse are a thing of the past, representing a widely held view in the international community. It is worth noting that both the entrepreneurial dialogue hosted by Chinese Premier Li Qiang and the Summer Davos Forum in Tianjin highlighted the waning enthusiasm of global investors for the Chinese market. In May, Li Qiang held a dialogue with entrepreneurs attended by representatives of 120 businesses from 20 countries. However, this was clearly smaller in scale than a similar meeting held with previous year under the chairmanship of former Premier Li Keqiang, which gathered 400 business representatives from 50 countries. At the Davos Forum in Tianjin, a noticeable drop in the number of international senior representatives was observed. The promotional approach of the forum also raised eyebrows. Prominent displays of President Xi Jinping's writings ostensibly promoted by Li Qiang, aimed to position Xi's ideology as the guiding principle for the forum and global development. This was a jarring surprise to international delegates who had expected frank dialogue with Chinese policymakers and business figures, primarily discussing economic, technological, and environmental issues. The atmosphere on the ground had evidently changed. On the business front, Goldman Sachs, the global financial giant, has decided to suspend fundraising in the United States, pivoting instead to seek investors in the Middle East and Southeast Asia. This strategic shift partially stems from new investment review mechanisms imposed by the US on China, leaving North American investors increasingly wary of investing in China. Simultaneously, two of Canada's major pension funds have chosen to pause their direct investments in China. Prominent investors such as Warren Buffett have begun to scale back their investment in China, shifting their focus to Japan and other markets. Over the past year, Buffett has reduced his shares in BYD 11 times, bringing his stake to less than 9%. Industries once viewed as investment goldmines such as artificial intelligence have seen Western investment banks pulling out due to potential US sanctions against China's AI industry. Goldman Sachs, for example, relinquished its role as the IPO coordinator for Beijing for Paradigm Intelligence Technology Company in April, following the company's blacklisting by the US Department of Commerce in March. Sequoia Capital, having invested in China's AI industry through its Chinese subsidiary, chose to separate its Chinese operations from the parent company. Meanwhile, data suggests that returns of investment in Asian markets, excluding China, have far outstripped those within China. For instance, the MSCI Emerging Markets Asia Index saw a net return of only 1.3% this year, but when China is excluded, the figure climbs to 8.6%. Korea and Taiwan were particularly striking, with market gains of roughly 20 and 30% respectively. This has sparked a new investment boom. Asset management firms report a growing demand from global investors for Asian investment products outside China. In light of this trend, Wall Street, traditionally focused on the Chinese market, is reevaluating and adjusting its investment strategies. Over the past 11 months, whether bonds or stocks, China's financial market have experienced selling pressure. Initially, American funds were selling, but in the past half year, European funds have also started to reduce their holdings. In the first 4 months of 2023, investors offloaded around 31 billion worth of Chinese government bonds via Hong Kong's Bond Connect scheme. Meanwhile, foreign investors' demand for Asian stocks and bonds outside China surged dramatically this year, with net purchases reaching close to 38 billion. Most noticeable is the 22.5 billion net purchase in May, setting a record for the highest monthly net inflow since 2011. These striking figures suggest that Asian market outside China may be brewing an economic boom of significant proportions. As China tightens its data regulations and the US ramps up auditing scrutiny, the benefits for Chinese companies listing on the New York Stock Exchange has significantly diminished. Overseas stock insurance from Chinese companies fell to 90 billion in 2022, with only 6 mainland firms managing to go public, far below the 120 billion levels seen in 2020 and 2021. Though activity has begun to rebound, pricing disagreements between unwillingly high-bidding investors and low-selling Chinese companies have stymied many listing deals. Furthermore, China's leadership is implementing stricter regulations on overseas listing of Chinese companies, aiming to keep more companies domestically. Under such pressure, including China Petroleum and 2 leading aviation companies, some Chinese concept stocks are considering delisting from New York. This could signify the end of Wall Street's golden era of assisting Chinese firms to list in the US. Due to various factors, foreign banks' participation in China's IPO market has dwindled to its lowest since 2009. Although mainland China's IPO financing totaled $26 billion in 2023, foreign banks' participation in China's IPO amounted to only $297 million, accounting for just 1.2% of the total. With American banks failing to partake in any IPOs, even Goldman Sachs ranked only 13th in China's stock insurance last year, trailing 12 domestic banks. Consider Syngenta, a company planning to list in Shanghai and raise $9 billion. We certainly aspire to participate in this IPO, a banker at a global bank in Asia confessed. However, he admitted, we're always questioning, can we really do it? If even renowned international corporations struggle to secure IPOs when listing in China, the prospects for international banks getting IPOs for Chinese company listings domestically seem rather bleak. Once lucrative offshore bond markets, which were a major source of commission for underwriters like HSBC and Goldman Sachs, have softened following multiple defaults by Chinese real estate firms. Although Hong Kong's IPOs are still key areas of businesses for global banks, China's competitors are gradually catching up. As for hedge funds, the share of investments in China's stock has dwindled from 13% at the beginning of the year to 9% by the end of May. This suggests that investors' confidence in the Chinese market may be waning, perceivably increased risk in these investments. Experts warn that a hedge fund pullback from the Chinese market could lead to a capital flight, putting pressure on the liquidity and market capitalization of Chinese stocks, and possibly even threatening economic stability. Further complicating matters is China's noticeable backslide in macroeconomic and corporate data transparency. The Wall Street Journal reports that stringent data sharing policies are hampering international mutual funds operating in China, making it impossible for them to disclose key information such as investment details, fund performance, and client identity to their headquarters. With the implementation of the latest Anti-Espionage Act and State Secret Act, Beijing is encouraging state-owned enterprises to gradually stop using the Big Four accounting firms. Consultancies conducting due diligence for global investors are being unexpectedly scrutinized by the Chinese government, while data providers like Shanghai Wind Information Co. Ltd., once important resources of research data on the Chinese economy and corporations, are now faced with restrictions making due diligence increasingly challenging for foreign investment banks. This explains why international firms' enthusiasm for large-scale IPOs within China is cooling. If due diligence is impossible, how can one consider going public? Compounding the issue, the reliability of Chinese companies' financial report is being questioned, and auditing activities are strictly restrained. A senior executive of a multinational company emphasized that the basic requirement for investment is the provision of comprehensive, fair information to protect investors' rights. Yet, in the face of China's current opaque data environment, Wall Street is hard-pressed to assure that its investors' rights are appropriately protected. All these actions send a clear message to foreign companies. The Chinese market may no longer function as it did, and Wall Street banks are forced to scale back their operations in China. Contrarily, the Chinese government holds markedly different expectations. In a recent meeting with Bill Gates, Chinese President Xi Jinping explicitly stated his anticipation for ongoing investments in China by private entities, especially American industry leaders, such as Wall Street's major bank and figures like Elon Musk and Bill Gates, to promote more foreign commercial activity, capital, and technological collaboration on Chinese soil. However, the foreign magnates visiting China have also faced significant hidden losses, and their recent trips to China may be more about polite responses to invitations than genuine investment intentions. Thus, for China, the challenge of retaining these wavering foreign investments or attracting new ones is substantial. These investors are not unchanging. The attitudes shift with domestic public opinion and political trends in the US. Currently, both the US government and the two major parties lean hawkish on the Chinese Communist Party, and recent opinion polls show that the American public mostly hold negative views about the CCP. This situation has made Wall Street and industry leaders wary of openly supporting the CCP, requiring them to tread carefully. If China's economy could continue to grow and the yuan appreciates, investing in China would naturally be a smart move. However, the reality is that China's economic growth is slowing down. Domestic economic conditions are severe and the yuan is depreciating, thereby increasing investment risks. These tycoons are forced to think thrice before acting. In retrospect, Wall Street's investment banks once reaped substantial profits in the Chinese market, leading an influx of foreign commercial activity, capital, and technology collaborations into China. However, their current wait-and-see approach and pullout might sway foreign companies that once followed in their wake to rethink their investment decisions, possibly even considering Southeast Asia as an alternative, further weakening the scale of investments in China. In sum, the global investment landscape is shifting. With changing protagonists, and China undoubtedly faces significant historical challenges, the exodus of foreign capital, internal economic pressures, and geopolitical tensions together paint a complex and turbulent picture.